Hey everyone, welcome back to Corporate Decoder, the place where we unpack the complex world of finance and business so you don't have to. And today we have a gem, a full annual report from Vishay INTERTECHNOLOGY Incorporated. It's a hefty document, but fear not, we will distill it down to the juicy bits so you can understand what is really going on under the hood. And if that sounds like your kind of content, make sure you are subscribed because we release these insights every week, and check out our brand new Discord community link down below to chat with other corporate decoding enthusiasts. Alright, so we have Vishay INTERTECHNOLOGY Inc. or VSH as you might see it on the stock market. They are a major player in electronic components, making everything from semiconductors like those tiny chips that power your gadgets to passive components like resistors and capacitors that control electrical flow. Think of them as the fundamental building blocks of almost all modern technology. This report covers their 2025 fiscal year, and let's just say it has been a year of strategic moves and some financial ups and downs. First things first, let's talk about the money. Their total net revenue for 2025 was about $3.07 billion. This is an increase of about 4.5% from 2024. So business is growing, which is generally good news. However, it is a bit of a recovery from a tougher 2024 where revenues dropped by nearly 14%. The main driver for this revenue increase in 2025 was simply selling more products, a 4.9% jump in volume, and this is a big but, the prices they got for their products actually went down by 1.9%. So it is like selling more widgets but getting paid less for each one. This price drop directly impacts their profitability. Their gross profit margin, which is basically how much money they make after accounting for the direct costs of making their products, was 19.4% in 2025. This is down from 21.3% in 2024. What does this mean in real terms? For every dollar of sales, they are keeping about 2 cents less than they did the year before. This squeeze is mainly due to lower selling prices overall, but also higher costs for materials and labor. Looking at their different product segments, the MOSFET segment, which makes those power controlling switches, saw a 4.7% revenue increase in 2025. Sales volume went up by a solid 10.8%, which is great. But again, prices dropped significantly by 6.2%. This caused their gross profit margin in this segment to fall to 9.8%. Down from 14.5% in 2024, this segment also had a negative operating margin of almost negative 5%. This means it is actually costing them money to run this segment, which is a concern likely tied to their big investments in new facilities like the Newport wafer fab. Now let's dive into their assets. They have total assets of over $4.2 billion. A big chunk of this, about $1.67 billion, is in property and equipment. This makes sense as they are a manufacturing company. They are investing heavily in expanding their factories, with construction in progress jumping significantly. This explains why their free cash flow, which is the cash left over after paying for operations and capital spending, was negative again in 2025 at a little over $87 million. They are spending a lot to build for the future. The inductors segment, on the other hand, shows a healthier trend this year with a 2.3% revenue increase. What is more interesting here is that their average selling prices actually increased by 1.4%. This is a welcome change from the general price declines across the board. Their gross profit margin is also looking strong at 27.5%, and their operating margin is a robust 23.3%. This segment seems to be performing relatively well. When you put it all together, their consolidated operating income in 2025 was about $56.8 million. That sounds okay, right? But remember that includes a favorable settlement of a contingency, which boosted that number by over $11 million. Without that, their core operating income would be lower, and comparing it to 2023, which had an operating income of over $486 million, it is clear they have a long way to go to reach past performance levels. The company is also undergoing some restructuring. In 2024, they announced plans to optimize their manufacturing footprint, including closing 3 facilities. This resulted in about $40 million in restructuring costs that year. These actions are aimed at saving money in the long run, about $23 million annually, according to their estimates. Now, what are the big risks Vishay faces? Well, it is a pretty standard list for a manufacturing company. The global economy is a big one, as their sales depend on how well their customers are doing. Intense competition is another. They operate in a highly competitive worldwide market with many players, some larger than them. They also face risks related to supply chain disruptions, which we have all heard a lot about in recent years, and for a tech company, protecting their intellectual property is always a major concern. They also mention the potential impacts of artificial intelligence, noting that their AI-related efforts, particularly with generative AI, expose them to risks like harmful content inaccuracies, bias, and intellectual property infringement. That is a pretty forward-looking risk. This is a really interesting point. Vishay has two classes of stock, common stock and Class B common stock. The Class B stock has 10 votes per S share, while common stock has 1 vote. This means holders of Class B stock have a huge amount of voting power, allowing them to effectively control the company. As of the end of 2025, the Zanman family, who founded the company, controlled about 44% of the total voting power, and their Class B shares represent almost 90% of all Class B shares. This structure means they can essentially block any major deals, like a company takeover, even if it might be good for common stockholders. Looking at shareholder returns, Vishay has been paying quarterly cash dividends since 2014, and they expect this to continue. They also have a stockholder return policy to return at least 70% of free cash flow to shareholders through dividends and stock repurchases. Even though they had negative free cash flow in 2025 due to those big expansion plans, they still managed to pay out substantial dividends and even bought back some stock. Their stock performance, while not spectacular compared to the S&P 500, has kept pace with some industry indexes, though it has lagged behind the booming semiconductor index. Overall assessment, so what is my take on Vishay INTERTECHNOLOGY Incorporated? On the positive side, they are a global leader with a vast product portfolio that is essential to many critical industries like automotive and industrial. Their strategy of investing in capacity expansion seems well aligned with major technology trends like electrification and 5G. They are also actively looking for strategic acquisitions. However, the financial picture shows some significant challenges. Declining selling prices across many segments are putting pressure on their profitability. Their gross profit margins have decreased notably, and some segments like MOSFETs are even showing negative operating income. The heavy capital expenditures, while necessary for growth, are impacting their free cash flow. The dual-class stock structure controlled by the founding family does provide stability in leadership, but also means major strategic decisions, including takeovers, are ultimately in their hands, which could deter potential beneficial transactions for other shareholders. Risks related to global economic conditions, competition, and supply chain disruptions are ever present, and their heavy reliance on international operations also exposes them to currency fluctuations and geopolitical instability. The company is clearly in a transitional phase, pouring money into expanding its capacity and capabilities. The hope is that these investments will pay off in the long run by enabling them to capture growth in key markets and offset pricing pressures with volume and efficiency. For investors, it will be crucial to watch if these investments translate into improved profitability and positive free cash flow in the coming years. It is a bet on future growth, but one that comes with significant near-term financial strain. Alright, that is our deep dive into Vishay INTERTECHNOLOGY's 2025 annual report. What do you think about their strategy and financial performance? Let us know in the comments below. If you found this breakdown helpful, give us a like and subscribe for more decoding of corporate filings. And remember, our Discord community is always open for more discussion. Thanks for watching Corporate Decoder, and we'll see you in the next one.